Hello, welcome to the first episode with Coffee with B. We here at Senfin Asset Management are all set to give you a trail of wonderful insights into the excellent methods of investing that offer you the potential to earn great returns, while diving into some intriguing economic and market talk. So today we have with us Mr. Jeevan Sukumaran, the CEO of Senfin Asset Management. And without further ado, let's jump right straight to the chat. Hi, Jeevan.
Hi Vimasha.
So I would like to start off with asking you, since you've been in the industry for almost 17 years, how would you explain about the unit trust to someone who's completely new to this, and how does it work?
So it's a very complicated topic if you were to go, given that there are many different kinds of unit trusts and each have different profiles, different targeted investors, but at their core, a unit trust is otherwise known as a collective investment scheme. So a collective investment scheme, I think the definition is in the name. So what that simply means is it's a collection or pool of investments of different people, and then that is collected by a separate fund manager, and then that is invested into a specific instrument, whether that instrument is fixed income or equity or whatever it is. The core concept is the money is pooled and then by a fund manager and then invested elsewhere. So the main point about that is that you get a lot of the time an individual investor or anybody gets access to some kind of an instrument that they wouldn't otherwise be able to get access to, and or they also get professional fund management expertise, and they don't need to essentially sit and monitor their investment over and over. So again, just to summarize, at its core, that's what it is. It's a collective investment scheme. It's a collection of investments from different unit holders, and then that is invested into whatever the instrument. Beyond that, to go into depth obviously would be a little bit, it will take a lot more time, but essentially that's what it is.
Right. Okay, and also to make it a little bit more clearer to everyone who's watching, what are the benefits of investing in unit trust compared to the other investment options?
Okay, so I think in answer to your first question, I think I mentioned two of those advantages. One is you get access to professional fund management. Right. So people like myself and my team, our job is this. So say, for example, someone else who is in a completely different industry, but they want to, properly, effectively manage their interest instead of, keeping the money in a bank and doing nothing or getting a joke of an interest rate. They would like to effectively manage their finances and get some good kind of return. But they don't have the time or the expertise because they may be experts in, say, the field of marketing or engineering or whatever, but in terms of financial management, that's not their area of expertise. Whereas for us, that's our area of core competence. So then that's one of the biggest things you get. Obviously, again, as I mentioned, the other advantage is you get access to instruments that you otherwise may not be able to. Yeah. So given that it's a collective investment scheme, one thing that the trust would obviously have is it would have bargaining power. So if your fund is in the billions, so say even if you're a high net worth individual, and even if you have maybe 50, 60 million to invest, you coming with 50 million, whereas me coming with 1 billion, I may be able to negotiate a slightly better rate than you would. Again, because I'm coming with the benefit of size. Another main advantage that you get is you get liquidity. So sometimes what happens is, for example, if you were to invest in a fixed deposit and that's a set time period, you can't withdraw it until it's matured. Yeah. But here, of course, you get liquidity. So we do overnight liquidity. Right. So, you can do a redemption overnight. So you get the liquidity of, say, a savings deposit with a return that is better than even a fixed deposit.
That will come soon when a client withdraw
right.
them.
So again, it comes down to the size, but generally within our firm, we generally tell people within a day's notice, we are generally able to do any kind of any redemption. It's not an issue, unless obviously it's extremely large, in which case we would prefer about 1 to 2 days notice. In any case, we are bound by the Securities and Exchange Commission of Sri Lanka. So they anyway have very strict regulations. So at most you don't have more than 10 days in any case, but obviously best practice is to give it within a day's notice. So normally what we say is, okay, we need a day's notice for a larger redemption. But obviously if it's very large, that obviously is on a case by case basis. But we are able to do redemptions even within a day's notice
I think that's
during
very
the day as well.
attractive.
Exactly.
Right. And also, Jeevan mentioned about the pooled funds, right?
Yeah.
So, like, what methodology of diversification, like the diversification?
Right. So again, very simply put, it differs obviously based on the type of unit trust. I think I mentioned at the start, if it's a purely a fixed income fund, and even then there are different types of fixed income funds, or if it's an equity fund. But at its core concept, and again, I think I failed to mention, diversification is another huge advantage of a unit trust. Say, for example, if you had say 50 million, or even 5 million, or even 1 million, or even 100,000. So the lower your investment values, obviously you would not be able to go into several asset classes. You would be constrained to just maybe one or two at most. But here, even our minimum investment amount is 1,000 rupees. Right. So even with 1,000 rupees, you can get access to a vast different types of investment instruments. So for example, like our money market fund, we invest in treasury bills, fixed deposits, we invest in repos, so we invest in bank deposits. So what happens is, even if you have 1,000 or 10 million, you will get access to all of these. So the advantage with there is obviously the advantage that comes with diversification. Right? You are diversifying your risk and you are diversifying your portfolio. So it's a simple put is, instead of putting all your eggs in one basket, you put your eggs into the unit trust basket, and then that is invested into different types of instruments. So you get that benefit where otherwise you may not be able to get that benefit. And again, even if you had the time and effort and money and investment value to put it into like 5 or 6, then you need to know 5 or 6 different instruments.
Yes.
So you would need to know what affects instrument A, B, C, D. Then you would have to monitor all 5, which are, I mean, there could be 5 different markets. So they could be affected by 5 completely different macroeconomic conditions.
Have the knowledge.
Exactly. So that brings me back to what I said at the start. You would need the knowledge, and more than knowledge, you would need a lot of time. So if you're someone with a day job who has a much more, it's not easy.
Yes.
So here, that's again something that you get. We are supposed to know, that's our job. So
Yes. I also have a small question. So do you think, like, when it comes to these economic situations, so when there are recessions and booms, like, how does these kind of situations impact the unit trust?
Right. So quite simply, whenever there is, so as I said, the unit trust invests in a specific asset class, right? So when there is something negative that affects that specific unit class, obviously you would have that same effect on the unit trust. So say the equity markets are going down, then obviously unit trust, if it's an equity based unit trust, that would also go down. But because we have diversification, because we have diversified the portfolio, because this is what we do 24/7, because we have basically knowledge of the industry, basically we may not have been able to predict it 5, 6, 7 months in advance, but still we may have been able to see something coming maybe quicker than someone who is not part of the industry.
Right.
So we would have hedged our investments, or we would have diversified our investments, or we would put our investments, we would adjust our investments expecting a negative down. So then what would happen is, so even if you see the market downturn, and even if the unit trust does go down as well, it will not be as bad as had you gone directly into that industry.
Right.
So for example, say if an equity market went down by 5%, we might go down by 2%. Why? Because we have diversified. So we would have some common, maybe if it's a growth fund, we would have had it in different industries. So some will not have fallen as others. If it's say a balance fund, a growth fund is basically where almost everything needs to be purely in equity. If it's a balance fund, you can split it on a predefined percentage between a fixed income, like a fixed deposit, or into equity. So say on a balance fund, say, markets are going to start going down, we would slowly start, selling whatever the shares we hold through the fund and start putting that into fixed income. And then the opposite is true. So given the current climate, where we're seeing interest rates now coming down significantly following the government's revival plan for the economy, you would have seen already equity markets have seen a significant improvement. So similarly, what we did was, when we had funds, in our balance funds, which maybe had a little bit more into fixed income, we slowly reduced our fixed income increase and slowly started putting that into equity.
Right.
So now, God forbid, if it turns around and we start going into a negative situation and fixed income rates start moving up again, then we would switch it around this way.
Right, perfect. And also, even I think you mentioned this before, also, like depending on the client's risk tolerance, they could change from right? So, how many, what do you call unit trust funds do we have at Senfin?
Right. So, Senfin Asset Management currently has 9 different unit trusts.
Yeah.
We have almost, I think, one of the most amount of unit trusts in the industry. So basically, we are going on a diversification on top of a diversification.
Yeah, and if you could explain like how much of it is going to
Yes. So what we can do is, I think our flagship, one of our largest funds is the money market fund, which I think is about almost 50 to 51% of our total assets is in our money market fund. So that's our flagship fund. And that's the fund that we generally push, and that's the fund that's quite recognized. I think the fund won at the CFA Capital Market Awards. It won the Best Unit Trust, Gold for the Best Unit Trust 2 years in a row, having won the Silver in the year before that. So 3 years in a row now it's been recognized. In addition, our funds are GIPS certified. We comply with the CFA Asset Management Code as well. It's on our own. We have to do that. And we are also almost finalizing our. In fact, I think we've got the rating, but it should be published any day now. So we've actually even gone and got ourselves rated by Fitch, because we feel like in a time like this, especially, transparency and all of that is very important. Separate to the money market fund, we also have an income fund. So an income fund is it's mainly into treasury bonds.
Right.
So in addition to the income fund, we also have a Sharia compliant money market fund for the Sharia conscious investor. We also have a Sharia compliant equity fund, which is where the stocks are invested as per the Sharia whitelist as well. Outside of the 3 fixed income funds, we have 6 equity funds. So we have one growth fund, we have a dividend fund, which basically, our growth fund is basically a standard equity fund which invests almost entirely in equity. That's, I think, our second largest fund. Separate to that, we also have a dividend fund, an insurance sector fund, a financial services fund, which is basically everything that's not in insurance, which is banks and financial, non-banking financial institutions. We have two specific sector-specific funds as well. Another one, we have a consumer fund, and that's it. So we have 9 funds in total.
And also, Jeevan, like most of the people are aware of bank accounts, and that's what they go to most of the time. So how better do you think that people are aware and are interested in unit trust over the years?
Well, having been in the industry now for 17 years, I would say that now it's growing.
Right.
One of the biggest issues we faced, obviously, is people knowing what unit trust is.
Correct.
And in this country, which has had a lot of scams, especially on the fixed income side, over the years, it's kind of left a bad taste in people's mouth for anything that's outside, say, a bank. But unit trusts are heavily regulated, and in fact, unit trusts have been around since 1992, and to this day, not one asset management company has collapsed. I mean, they're doing better than ever. I mean, there are other unit trust management companies that are doing phenomenally well, collecting huge sums of money, and they are extremely well managed. And the company is well managed, the funds are well managed. So the industry is on a very strong footing, and this is also in part to the work of the SEC, who are very strict and strict to a point there where sometimes it makes life difficult for us as the fund manager, but I think it's necessary. So I think it's necessary to have that kind of regulation. In addition, all funds need to have an independent trustee. So our trustee is at National Bank as well. That's why I think you have this kind of growth that we've seen in the last few years. But I would say that now, gradually, there is a lot more interest, and a lot of funds are going out there and doing what
people are more aware.
Exactly. But I think what needs to happen is we need to go back to maybe a school level. And this needs to build into curriculum, because most of the time people only find out about unit trust either A, when they go and they in their studies, which covers it, or once they start working.
And also, so speaking about the fees and all of that stuff associated with these funds.
Right. So generally, fees on unit trusts are very, very low. So they don't go more than 1 to 1.5% of per annum. We recently reduced our money market fund fees, and we are actually the lowest in the industry right now. We have the lowest money market fund fees. It's a fact. in the industry with effect from 1st April. It's not an April Fool's joke.
Yeah.
We have the lowest rates in the industry. What I think clients need to understand is either way, whatever the yield that they see or the return that the fund is giving is net of those fees. So clients don't need to pay anything more. So whatever they get, that's net. The final return comes to them. So that's how the fees work. No fees charged from the client, no fee. All fees are charged to the fund, and either way there are very few fees. There's your trustee fee, there's a management fee, you might have a custodian fee. Anything more than that are very non-material fees, like say an auditor's fee.
Entry or exit fees.
So entry and exit fees are there only for specific kinds of funds.
Right.
So a money market fund will have no entry fee, no exit fee. It shouldn't, no money market fund.
Yeah.
But some funds have entry fees, some funds have exit fees. So just to speak from our company, our growth fund has an entry fee but no exit fee. Our income fund has an exit fee but no entry fee. Other than that, the other funds don't have it. Our Sharia balance fund, again similar to the growth fund, has an entry fee but no exit fee. But all of our other funds don't have any. But generally, if you are putting entry and exit fees, it's generally for an equity fund, if at all.
Right. Okay.
And even those are very, very low.
Yeah. Right. Okay. So finally, I would like to ask you now. You mentioned that the minimum investment amount is just $1,000, very small. And is there any criteria that these investors have to meet in order to invest in these unit trusts, or like what are the suitable?
No, so there's no such suitable. Obviously, we have to do our due diligence, and there's a very strict process that we have to follow in terms of know your customer requirements. But I mean, all you need is basically a bank account and a NIC, and you have 1,000 rupees, and you can invest in a money market or any unit trust for that matter. Obviously, we have to do our due diligence on the client in terms of, whether they are affiliated to political affiliations, where they come from, and all of those things.
Okay.
But again, there is no hard and fast rule that, if you're this, you can't invest. Even foreigners, even people from abroad can invest, but obviously it needs to come to the proper government channels. But, anybody can invest in a fund, as even a minor can invest, as long as, they have someone who is above the age of 21 as a joint account holder.
Right.
So we actually have a lot of investments where people have invested for their children. So the account is actually in the name of the child, and they are the guardian or parent or guardian. They have been put as the co-investor.
So I think we have come to the conclusion of our chat, and thanks a lot, Jeevan, for sharing your wonderful. And also, if you are a potential investor and interested in investing in unit trust, please don't hesitate to get in touch with Senfin Asset Management. So once again, thanks Jeevan for joining us, and also a special shout out to DBU for hosting us today. See you again with another episode of Coffee with B. Thanks for watching.